If you want your home cinema to feel like a real cinema, you need to hear MAG Theatron. With more than 20 years' experience in commercial theatres worldwide, MAG's award-winning speaker systems deliver the same cinematic impact, now purpose-built for residential use. Made in Ukraine and engineered in-house, up to 95% of every transducer is MAG's own design. From high SPL loudspeakers to infrasonic subwoofers and DSP-loaded amps, MAG Theatron is the real deal. Exclusively available in Australia through Integrate Unlimited. If you've ever wished for a design partner without the overhead, meet Colosseum. Launched in 2024, Colosseum is a white-label design and engineering service built specifically for integrators, whether you're new to the game or running million-dollar installs. They turn basic floor plans into detailed, high-impact cinema-ready documentation, brand agnostic, collaboration first, and led by industry veteran Paul McLean. I've seen the work myself. This is world-class support for serious cinema projects. Colosseum, your behind-the-scenes design team. Hello and welcome to Master Integrator, the podcast where we explore the business of smart home technology from design to delivery and everything in between. I'm your host, Paul Skelton. Before we begin, a quick thank you to our sponsors, Integrate Unlimited, the exclusive Australian distributor of MAG Theatron, Colosseum, the design and documentation wingman you didn't know you needed, and Connected Magazine, your trusted source for smart home and AV industry news. Now, I don't know about you, but I've seen more than a few jobs go sideways because someone didn't read the fine print, or didn't have any fine print to start with. A handshake agreement, a late payment, a change in scope. Suddenly you're chasing money, holding back gear or worse, watching your hard work disappear with a liquidated builder. That's why I wanted to have this conversation. Today I'm joined by Angela McDonald from Optimum Recoveries and Craig Mason from SMS Law. These two deal with late payments, broken contracts, and debt disputes for a living. And they've seen it all. In this episode, we talk about what integrators get wrong when it comes to terms and conditions, what the law actually allows and doesn't, and how tools like the PPSR and security of payment legislation can help protect your business. If you've ever been burned on a job or want to make sure you never are, this one's for you. This is Master Integrator. Here's Angela and Craig. Let's start with Angela. For those of people who are listening who haven't come across Optimum before, let's go into a little bit about what Optimum Recoveries is, your background and your road to get to where you are.
Goodness. Okay. So my name is Angela McDonald. I am the Director of Optimum Recoveries. We are a business that helps our clients prevent, manage and recover debt. And the aim, of course, is to ensure that the cash flow is smooth and not bumpy. So we started our journey in 2009 and we started out as a very traditional debt recovery agency, pay or we'll sue. And it frustrated me to see so many avoidable debts coming through. So probably, 2 or 3 years into the business, we started working in more of a consultative way to try and help businesses prevent debt, because prevention, better than cure always. So that looks like making sure people start off their relationship with a new customer with great foundations, so good contracts that are fair for all parties and are really clear in terms of scope and deliverables and who's to do what and when, including payment. We help with cash flow management, so where a business is emerging and someone's really great on the tools, but not so great with paperwork, we might help with doing the credit management piece, so making sure invoices go out, the invoices are correct, and that there's a nice progressive follow-up process for making sure that they get paid as near to on time as possible so as to not impact the growth of the business. You can't grow your business on IOUs. And then we have the recovery piece. So as we go through our funnel, I guess, of new sales in and payments, there will be a few that can't be paid or won't be paid, whether it's the customer's poor attitude or their ability has changed along the way. There'll be some that need more formal steps. And that's where we partner with SMS Law and Craig Mason, who's joining us today, to complete that legal piece of the invoice to payment cycle.
Excellent. So Craig, I'll kick it over to you then. Why don't you introduce yourself and let people know about your background?
Great. Yep. Thank you, Paul. Angela said, I am from SMS Law, legal practice director there. And as part of what we do, we act for small to medium-sized businesses. And that's, recognising the challenges that they face from that environment, helping them with, advice about a variety of things, but in particular, litigation, debt collection, insolvency, and having the right things in place, agreements wise, contracts, et cetera, when you start the business or even along the way. But as long as you've got something in place, it's really important. That's what obviously we're going to talk about further today. But yeah, we love working with small and medium-sized businesses in this space, particularly, as things are getting more difficult. There are a lot more regulations and legislation that people need to be aware of when they're dealing with other businesses or consumers.
I think it's really important to note that as business owners ourselves, we partnered probably just over 10 years ago now, and we had a similar idea in terms of that prevention message. Let's get the right foundations in place to make sure that people are paid on time and with the least amount of hassle in the process as we possibly could. So that's a good partnership between us at the top and tails of the prevention, management and recovery piece.
So let's then look at the current landscape of payments in Australia. What are you seeing out there? Are you seeing that more small businesses are struggling to get paid or struggling to pay their own bills? What is going on?
Well, it has been a rough start to 2025. In the first quarter, I think the sector to be hit hardest was the hospitality sector. We saw record closures in that space. When I say record closures, we're talking about 1 in 10 venues have shut down. They've thrown in the tea towel. It's not just hospitality, though. It's across all business sectors. There are business stresses, and those stresses have jumped by about 47 to 49% year on year. One of the biggest red flags there is around overdue debt, and we're seeing a huge rise in the number of accounts sitting at 60 days or more before they're paid. So by the time we got to April this year, the other ping in reporting was that payment defaults for B2B, so business to business transactions, were 42% higher than the same time last year. And it's hitting everybody from big players to small businesses, particularly hitting tradies. We're seeing some increasingly high insolvencies. So we're still historically higher than any other pre-COVID period in the number of entities that are going into some form of insolvency. That could be liquidation, it could be administration, it could be one of the new small business restructuring schemes, but some form of insolvency is at play. That settled a little bit, I guess, in May, but they're still sitting at levels that are higher than we've seen before. And June's seen a bit of relief, a bit of cash flowing from that first part of the year. But I think with the government's decisions to increase the minimum wage by 3.5% on top of the superannuation increases from the 1st of July, that'll put some increased pressures on businesses again. So it's tough. It's tough. Manufacturing is toughest. Construction's paying really slow, and retail is paying slow as well. And larger businesses somewhat setting the pace because larger businesses aren't paying their SMEs in some instances up to 120 days past due. So when you think about that invoice to payment cycle that we were talking about, it always reminds me of a tire. And if somebody slows down that payment process, it's akin to getting a flat. The economy gets a flat. So if we pay everybody on time, that works well. And I think that the government, particularly the Small and Family Enterprise Ombudsman's office, is bringing in some payment reporting and hopefully compliance efforts that might help that.
Yeah, look, it's hard to know exactly what the state of play is. As you said, it's definitely not back to what it was pre-COVID, which is still, whilst a while ago now, still affecting business, just the aftermath of that. And you've got the ATO as well that have not done anything for some time, and they're ramping up in terms of what they're doing. They've got more mechanisms to collect debt, enforce debt, make it harder for a business to avoid paying it, for instance. And there are things that are coming through in terms of the reporting that is going to have a massive effect on business. And as Angela said, with hospitality, there's definitely a increase in insolvencies. And then the building and construction industry, whilst there were some insolvencies, it wasn't over and above what is the normal for that. Despite the media's overview of what was happening, they like to pick on the building and construction industry a bit, but it really held together reasonably well. And now that suppliers and the costs of building things are coming down, I think it's having a better effect on the building and construction industry as well. So, yeah, it's a interesting time, I think, is probably the best way of describing the state of play at the moment.
I think you touched on two really good points there. One was the ATO. So the ATO didn't do a lot of recovery of tax debt over that COVID period, and that's really changed now. They've got to repay the monies that they gave to everybody, and their collection methods are more streamlined, I guess, than the processes that any other creditor might go through. And they have more powers to extend debts, company debts, by serving director penalty notices. With director penalty notices, we have a very explicit way, very prescribed way that we have to serve a claim or some form of enforcement document. We've got to prove it, we've got to provide affidavits, we've got to do all sorts of other things. But the ATO just has to mail it to 2 addresses. It doesn't even need proof that it's come to your attention before they can start to pursue a director for the debt. So if there are any notifications coming through to any of your listeners, popping your head in the sand isn't the best way to deal with that. Responding to it and whizzing off to the accountant is the best way to deal with that. Craig also touched on construction as being a sector that really gets a bit too much spotlight in the press around how badly it's trading. But what a lot of people don't understand in terms of the number of construction entities that start or finish, it ties in with licensing in different states. So there are some requirements that see a developer having to create a separate company, separate entity, and separate bank accounts for broader protections for a specific product. So there's no intermingling between products. So you do have those openings, and then when the projects are completed and the retentions are paid, you have them closing. So Craig mentioned they're not looking as bad as they're painted because of all of the ins and outs, the opens and closing within the sector. It's how they're required to do business. But it is an interesting time, definitely.
Where are we in the cycle then? So you said obviously the start of 2025 was quite rough, but there's been a little bit easing off in the past couple of months. But do you think with what you're seeing, it's likely to continue or return to the pace that it was at the start of 2025? Or are we actually easing off back into almost a sense of normality at the moment?
I think we're probably going, the new normal, I guess, is probably the way to describe it. Yeah, there's a bit going on, but I think optimism is out there, and I think it's going better than probably what it was at the beginning of the year, business-wise. But, they are expecting an increase in insolvencies, maybe not this year, but next year, when the true effect of what the ATO is doing now comes home to roost, I think, probably next year.
The ATO and the big 4 banks. And I think from my perspective, the government tells us we're not in a recession. We are seeing lots of optimism. We're seeing a lot of new businesses open. There's certainly, again, a lot of inquiries through the Small Business and Family Enterprise Ombudsman about how to open and operate a new business. Whether that's employees feeling a bit unsure about things and maybe setting up a side hustle, I don't know. That could be part of it. But maybe it's a bit of a level up, a new normal, as Craig said, where businesses that were propped up are having a bit of a shakeout. I can see that. There are some studies coming out around, again, that small business space. So the small business sector is the biggest employer in Australia, but we're seeing some businesses where the business owners are older, the business owners are soloists, so more micro businesses. They've created a job for themselves as part of the economy shakeout, but in some instances, they're not paying themselves a proper wage. So we'll see the tease out of that later on as well.
So, a question for you, Angela, especially within your remit and debt collection. From what you're seeing, then, do you think there needs to be an attitudinal change towards debt collection or just getting paid in general, especially among tradies? Because there is a mindset that I see that a lot of tradespeople, especially within the integration world, seem to treat their clients like mates rather than clients.
Yes.
So, are you still seeing a lot of that come through? And if there needs to be that mindset shift, how do you make that change? How do you get that through to change how they operate business?
It's interesting. I had a conversation with a fellow yesterday who's in an aligned industry to what you're talking about, not exactly, but aligned. And he'd had some mates let him down and ghost him in terms of payment of the account. It really has an impact on his business, but it also has an impact on his mental capacity to handle these hits. If you're constantly getting hit, how do you keep getting up? The thing that we talked about with him was, could there be an alternative finance mechanism? So something that allows him to not take the risk. And we've identified a finance group that can offer the customer funding, particularly if it's a consumer rather than a developer or a business, where they take the risk and they take on the account and he's paid up front. So that will help him with some of his projects. Where he is doing bigger projects and he needs to sign on to somebody else's contract, you need to make sure that the contract truly is fair for everybody. Make sure your paperwork's up to date. The majority of the disputes that Craig and I see in relation to accounts come back to scope creep, invoices that aren't clear or correct or weren't sent to the right place. That's 3 really simple things that people can get right in their business. Keep clear track of variations if they come along as part of a project, and they do. Things aren't always as they sit on a blueprint, and make sure that communication stays clear.
Yeah. And I guess the other side of that too is that it is completely okay to fire a client. And I know that seems like a foreign concept to some people, but you can absolutely fire a client if they're taking advantage or if they're not paying or they're doing something that's going to have a negative impact on your business.
Totally. Your best client is not the bloke that's not paying you. And we also have that conversation of, I can't possibly start collection action on them. They're my best client. No, they're not. They're the person that's using you as a free bank. And that's not respectful of the relationship. So I think great foundations. Craig and I are big on great foundations in terms of contracts, making sure that, again, the scope of the project is really clear, the deliverables. We quite like time payments, so payments at certain stages of the project, progress payments, and other securities. Craig's going to talk a little bit about the PPSR shortly and some other securities that people can put in place. But for me, it's good contracts, it's good procedures, it's good processes, but all of it is based on solid communication. I do love a good credit check as well. Paul, you and I have talked about that before. I do like to watch and monitor. So I like to make sure that when we're working with clients, that they know who their customers are. They understand whether or not the directors of the business have been involved in other failed entities before, because if they have, it increases the likelihood of failure now. And to have a look at their risk score and payment likelihood. So how likely is my invoice to get paid? Know all of that good stuff up front, and then make an informed decision as to whether or not you want to take on the customer. And when you do, or if you do take on the customer and they have a credit rating that isn't great, have the conversation up front. What that might mean is that you won't necessarily not deal with them, but you might deal with them differently. More money up front, more time payments, or as I started to talk about at the beginning, having financial backing and getting somebody else to take the risk.
It's quite interesting too, because what you've just said around integrators also applies to the suppliers in the industry, in that Our industry is very incestuous. Everyone's worked for everyone else. They've all known each other for a long time. But as a supplier, I know they carry a lot of debt because they expect the integrators and their clients and their dealers to treat them well, but it doesn't always work out. So I do know suppliers out there carry a lot of debt, and it's the same process, same mentality of they're not your best client.
Absolutely. So what percentage would you say would the listeners have that would be business to business clients versus business to consumer?
So it sits in Australia about 50%. 50% of residential integrators will also work in the commercial sector. So in other words, everyone listening to this will work in residential and half of them will also work in commercial. When we talk about commercial, we're talking light commercial. There is a horrible word, resi-mercial, which I hate, but they do say it a lot. But it's essentially summed up as things like boardrooms, hospitality, small retail spaces, and houses of worship is the other one. That seems to be the tipping point. Once they get to churches and other houses of worship, this is when they start to move more into the commercial sector full time. But it is that kind of light commercial space where there's definitely an element of B2B clients.
Interesting.
So let's talk a little bit about prevention. You've mentioned a couple of things already, but we'll go into each of these separately. But as an overarching, response is, what are the key legal or compliance issues or structures in place that integrators need to be aware of?
I didn't say at the beginning that, like with anything, the sort of stuff that we're talking about today is, general overview of things. It's not specific to anyone's circumstances. And, if there's any specific questions about someone's particular circumstance, then our details will be available to reach out if you've got a question. But this is general advice and not specific. So there's our disclaimer to cover that. If I was asking, look, the legislation you've got, depending on what you're working in, but you've obviously got the legislation that governs, the building and construction industry. In Queensland, you've got QBCC, you've got the security for payment legislation, which is pretty similar across, Queensland, Victoria, New South Wales. So that's now called the Building Industry Fairness Security for Payments Act here in Queensland, which is all about building work or construction work, but only with developers and builders, so subcontractor to builder or subcontractor to developer or something along those lines. It doesn't cover if you're doing work for a homeowner. That's under the Domestic Building Act, so that would be another act you need to be aware of. But when you're dealing with builders, for instance, or developers or something along those lines, the security of the payment legislation is vitally important, because like with anything, how you start the relationship and what you have in place at the beginning is what you can use if something happens or there's a dispute at the end. So whilst, going back to the point about, dealing with your mate, everyone's mate at the beginning, and then when what hits the fan, they no longer mates. But a whole point of a contract, and the reason that all this legislation exists, is it's not to put one party at an uneven playing field and to give more power to someone else. It's the whole point of an agreement, and this legislation is to put everyone on the same footing. There's no more power to anyone else, and it's not all negative in a contract or legislation. The whole point of the security for payment legislation is to keep the money flowing in the building and construction industry. It's not to punish anyone. Essentially, the attitude is pay now, and if you've got a dispute, then you can deal with it along the way. But what it's designed to stop is the stopping of payments and just sort of putting your head in the sand and not dealing with it. The whole point of it is put a structure in place that allows for strict timeframes where certain people need to do certain things within that time to allow the money to flow. Which, in my view, seems like a good idea, and it protects everyone. So, but as I said, if you don't have it at the beginning, then you can't rely on it down the track. So, like with anything, you need to have agreements in place. Make sure you're considering the fair contract rules as well that they've been in for a while, and they still haven't necessarily been tested to much. But essentially, the gone are the days where you can have an agreement that allows one party to terminate whenever they want and the other party has to, cross every T, dot every I, send out smoke signals, jump over the moon to terminate. They've changed all of that to mean that if one party's got a right to terminate, with 30 days notice or something like that, then the other party should have that as well. So you just got to be careful of the fair contract legislation as well to ensure that it's fair. And that's, as I said, it hasn't necessarily been tested, but I think if you take the attitude of, does this seem fair to me if I was on the other side? And if you say no to that, then maybe it could be considered unfair. So
the pub test, Craig.
the pub test, yes. So looking at those sorts of things, privacy laws as well, when you're collecting information in agreements, you just need to be careful about that and have the right disclaimer in your documents. And depending on who you're dealing with, there may be, if you've done it right with the privacy, you may be able to list defaults and those sorts of things if there's been a breach of a payment. But yeah, I mean, they're the main legislation. You've got QBCC, which you've got to be aware of as well if you fall into that category. But generally, the most important legislation is Security for Payment Acts, wherever you might be, privacy, fair contract rules under the consumer law, and obviously you've got all your building stuff and standards and those sorts of things you need to adhere to as well, but they're probably the main types of legislation that need to be in your contracts. And then you've got the PPSR legislation as well that you need to be aware of. And like with anything, if you don't have it in your agreement, you can't rely on it in the future. So our attitude is put everything in there. You may not need it, but you might need it. And if you don't have it in there, you won't be able to rely on it. So it's important to have as much in there as possible. As I said, it's all designed to govern the relationship. It's not I'm going to do things to you. It's, if this was to happen, then I might be able to do that to you, and vice versa.
So in addition to all of the legal requirements that need to be in play, I keep circling back to the scope of works and making sure that the scope of works is clearly described for coverage of what is, and particularly what isn't included, no grey areas. So we've got to cover off assumptions, exclusions, an agreed variation process, and also outline any stages or milestones. We didn't tap on pricing. So total pricing or hourly rate, if you're going to do a do and charge, is really important. The payment schedule of maybe when the deposit's paid, progress payments and dates, and then finals. And what might happen to the project if any of those milestones are missed. Payment terms, so whether it's 7 days, 14 days, 13 days, 14 days, whatever it might be, whatever you agree on with the party is appropriate. We hear when we're speaking to different people, some COD, smaller jobs can be COD, some might be on short terms, but then you're dealing with the larger developers. And as we talked about, while the agreements there might be 30 days, if your documentation isn't absolutely right and you don't understand the process or you're not easy to pay, then that could take up to 120 days, which is an impact on the business. Craig touched on ownership of goods, and the PPSR is one of those aspects, but we do still encourage people to include a retention of title clause, which is where the goods remain the property of the supplier until they're paid. But you do need those PPSR requirements or mentions, and you do need to register on the PPSR, which we might get Craig to circle back on in a moment. One of the things that people forget about is rights of access, and that might be important to you. So permission to access a site, to deliver and install, repair, inspect and retrieve, all of those sorts of things. And there should be some sort of indemnity to protect the installer from property damage, which might be outside of their control. Nobody plans to fall through the roof, but I've heard it happen. All right, so delays and what might be the client's responsibility. I remember at the conference speaking to people about delays on delivery that weren't their fault that caused that cascade effect. So again, in the contract outline, who's responsible, what and when, making sure the sites are ready, power availability, approvals, all of those sorts of things. Warranties and disclaimers, I think, would be important for your kit that the guys install. And the other thing that would come into play is the licenses, because you're setting up a lot of tech that includes passwords that includes acceptance of different EULAs, and you're accepting that on behalf of somebody. So perhaps we'll talk to Craig about how that lands. The other thing I'd like to see included is dispute resolution.
Connected Magazine is your go-to publication for the commercial and residential AV and smart home industry. Let's Talk Insurance is one of the biggest headaches for integrators, and with a lack of industry recognition, the challenges just keep growing. In this edition, Connected digs into which policies integrators are using, whether they actually work, and what needs to change. Grab the latest edition of Connected Magazine or visit the website for more news, analysis, and product coverage. Links in this episode's description.
So, what does a dispute resolution process look like without having to get into a long, drawn-out and expensive legal action? Could there be mediation or something like that? Craig touched on privacy and data usage, but maybe a bit broader with what you're doing with the electronics. And a force majeure, a bit of an act of God. If something gets stuck on a boat, it's not your fault. Craig, do you want to cover off the licensing and permits and compliance there when the guys might be setting up a system for somebody and adding passwords and accepting terms and conditions that relate to equipment or software?
So the idea of informed consent, basically.
Yeah, well, I would get that consent ticked off before you do it. So that would be part of your engagement documents, would allow you to do that. Obviously, you'd need to store any passwords and those things securely. And then at the end of the project, I would have thought you hand it all over and you have a mechanism to delete all that from your system and put that in your terms and conditions as well that, we're not going to have a backup for this. This is now your responsibility if that's the way it would best work. But yeah, I'd be getting some form of consent from the person you're dealing with that, you're going to enter into licensing agreements. There are going to be terms and conditions and you've got the authority to accept those and then hand over passwords at the end. I don't know if there's an ongoing management of these sorts of things, Paul, or if there is, then obviously I'd have a separate agreement for the management, the ongoing service, which would then mean you would keep passwords and those sorts of things, but obviously keep it securely and have their agreement that you're going to keep those.
So you mentioned terms and conditions. This one, it pains me to say, because I know there are integrators out there, some who will be listening to this, that they developed their terms and conditions by scraping them off a website. Essentially, they saw terms and conditions on someone else's website or a competitor's document and said, I'll take that. What is the risk of doing that and having terms and conditions that aren't specifically tailored to your company and what you're offering?
A long list. I mean, you see it all the time where people do that. And, I get why they do it. When you're just starting out, you want to get something together. At least they've taken that step. It's better than some people that just don't have anything. But, the copy and paste from someone else's website, you see things like the jurisdiction clause is California, America or something like that, or it refers to the Trade Practices Act, which was repealed, 10 years ago or something like that. That's the risk that it has things in there that are outdated, irrelevant. And whilst it might be a similar business, they could do things differently as to how they engage with their customers, and it mightn't suit your business. It's better to have something that's custom and something that you can add to along the way. But yeah, copying and pasting from a competitor's website or something like that is, fraught with danger.
I've seen clauses that were irrelevant to the sector that the company was working in. It didn't match with what they were doing. And the client's response to that was, it sounded good because it sounded legal. It sounded like it might be official, but it wasn't relevant to their sector. We've seen more recently with maybe a ChatGPT style tool being used that it referenced legislation that didn't exist. And I think that happened in Parliament recently too. But it referenced something that didn't exist, and it doesn't necessarily provide the protections that they think they do. I think also, if in this day and age, I love contracts that are full of plain English. You should be able to understand it. You should be able to explain it to your client, and your client should be able to understand it. And a lot of the documents that I see make me, and I'm pretty familiar with contracts, but they make me want to run off to my solicitor, Craig, to have them interpreted. And that's a barrier to business. So I'm with Craig in terms of make sure your documents are tailored to you, tailored to your style of business, tailored to the type of entity that you're going to be dealing with. So what I mean by that is if you're dealing with a corporate, then make sure that the contract's aligned to that. If you're dealing with a consumer, make sure the contract's aligned to that and references the right codes and acts, and make sure they're fair. But yeah, plain English is my vote.
And you can have very good terms and conditions in plain English. It doesn't have to sound like legalese.
Yeah, exactly.
Best it doesn't.
Yeah, like you got to have some certain things potentially in there, but it doesn't have to be, this and that and Latin and various other legal things in there. That's for sure. Because as I said, it's an agreement between two parties that both want to do something and get benefit from it. So it's better to be, more informal than formal. Because as Angela said, if you present it with a 32-page document that's got this and that and here too and various other legal things in there, you're either going to put it to one side and not deal with that person, or incur costs of having to go and see your own legal representative. So yeah, better to be, what did you say, Angela? Conversationalist sort of terminology.
Plain English and able to be something that you understand as the business owner, something that you can confidently explain to a customer, and something that the customer can clearly understand.
So something that has come up a little bit on this call is an acronym that, I was familiar with it, but I didn't understand how it necessarily worked. And I would hazard a guess that if not all, the vast majority of people listening to this would not have heard of PPSR.
Mm.
So let's start with a really basic description of what the PPSR is and how it works.
All right. It ties in with the Personal Property Securities Act, which allows you to legally recover goods and claim secured creditor rights to protect your goods. And within the Act, there's a register, a bit like what you would use for a revs check on a car, but you're able to record your interest in an item or items that you have provided to third party, your customer. There are different ways to register, different sectors that you can register in, and that covers whether or not your goods are the standard goods to be sold, or whether or not your goods are integrated into something else. And that's where I hand over to Craig.
Yeah, so if you are installing something, for instance, you could have had, if you had it in your documents, of course, a registration for that. And even if it's then installed in the structure, you may not be able to go and pull it out. For instance, it could be commingled with something else or whatever it might be. It doesn't mean that you lose your interests in that case. You've still got the interest for the monies that are outstanding in relation to those, equipment or whatever it might be. So that's where it will become relevant. Or it could also be, depending on how the situation is, but say there was a delivery to a new project, say it was a new build, for instance, and there was delivery of a large amount of equipment for one of the listeners' businesses, and it was left there for a period of time until it was to be installed. Then if you had a registration and something happened in the meantime, you would potentially be able to go and get all that back because it's all identifiable, because it's yours and you've got the serial numbers from the order or something like that. You could potentially go and get that back. You'd have to get the timing right, obviously, that it hasn't been installed and something happened to that builder or something happened to the developer or whatever it might be. They're probably the main two circumstances where you'd be using it. But if you don't register within the period of time that you need to do it, you lose that. So it's important to consider that. And say it was a larger job, for instance, provided it's in your terms and conditions that it allows you to do a registration, it needs to be a security agreement. There's various things that need to be in your terms and conditions. You can't just, have one line about it. There's a number of clauses that need to be in there. You could register an interest but if you don't have it in there, you can't. So as you go along, if you've got a larger job or there's a large amount of equipment or whatever it might be, then you can do it sort of as a case-by-case basis. You don't have to register it for every single job you do, but you definitely, the larger type jobs, should be making sure you've got proper agreements and a registration in place.
Is there a limit on what someone can actually add to the PPSR? So, for example, one thing, could be a very large loudspeaker, a very expensive loudspeaker, but could they go down to the level of perhaps registering a keypad or a light switch or even cable?
Yeah, I don't know how much all that stuff is, but yeah, you could have all that in there for sure. The whole, box and dice, essentially.
And what about tools? So if you had a fiber splicer or a termination set, that sometimes they can cost 25, 30 grand. If you had that out on a job site and you were using it for the installation on that job site, can you have that registered on the PPSR?
Well, it's yours. So if they say that job site got shut down because the builder went into liquidation, for instance, then the liquidator would or should release that to you because it's yours and you'd have proof that it's yours. I don't think you'd register interest on that one.
One of those points of proof might be actually if you've financed the item, because those splices are expensive, aren't they? If you finance the item, then it's likely that your financier has registered their interest on the PPSR against that item. So it'd be really easy to prove that it's yours and not something that was supposed to be integrated into the build. And overall, the Personal Property Securities Act and register that goes with it is a really powerful tool that protects rights to get paid and get your goods back. In the past, if you just had a retention of title clause in your contract that said these goods are mine until they're paid for, or some forms of guarantees, you don't know how many guarantees there were. You don't know how your goods are going to be intermingled into things. Craig tapped on a really good point, and that is you need to be able to identify the item. So whether that's through a serial number or a code or markings or something like that, you need to be able to identify the item. You need to also register the item or your interest for the items or works under Act before the works commence, not afterwards. You can't do that retrospectively. But something that we didn't touch on is that it is a national government-run online register that lets you record a security interest over goods or assets that you supply. So it's kind of like a digital claim tag that you can put onto your item. You attach it to your product and the equipment, when it's delivered, then on payment terms, if your customer doesn't pay or goes into some form of insolvency, then you can legally reclaim those goods or be treated as a secured creditor if your stuff has been intermingled. So if you supplied or installed an AV set or some security systems or other electrical products, you did that on terms of 30 days, you leave the goods on site before you're being fully paid, or even if you lease or rent an item. I've spoken to some of the integrators connected with you, and someone's system might fail and they bring in another piece of equipment to get them up and running again. If something then happened, you need to make sure that that loan item was covered by the PPSR as well.
And Angela, do you know the cost of registering on PPSR at the moment?
Look, it's cheap as chips. I think it's the lowest cost insurance that you're ever going to be able to buy. So if you want to register a security interest for 1 year only, it's $6. To extend that to a 7-year period is $25. Unlimited, so somebody that you deal with all the time. So Paul, you mentioned the suppliers to the sector before. That's $115, so no end date. And to do a search on the PPSR, if you're buying a new piece of equipment, you're buying it from somebody else to make sure that it's unencumbered, the cost of a search is only $2. So it's really reasonable, and it's probably, as I say, the cheapest insurance you're ever going to buy.
And you mentioned suppliers there, and that's an important one because a lot of suppliers will loan equipment to their dealers, to integrators, to have in their showrooms. So we're not just talking about integrators working on job sites, we're also talking about suppliers. And just to be really clear, this is B2B only, it's not B2C, is it?
Yes.
So how does an integrator or a supplier in the industry actually access the PPSR to register their interest?
Well, to start with, you need to have it in your agreement, which I've touched on a few times. And then after that, you can register it yourself, but we don't necessarily recommend that. There's places out there that will do it for you and then take care of all that. Angela, is that generally the way you still do it?
We don't register on the PPSR for people. We have an external party that does that for us. So you can go to organisations like Access Intel and speak to the team there. What they'll do is have a look at your foundation documents and your contracts and your PPSR clauses and consider the style of business that you're in to make sure that the section of the PPSR, so the code, is appropriate and the type of registration is appropriate. The other entity that does it is Creditor Watch. They have PPSR Pete that is the expert in that area. But we've found Access Intel is owned by a number of people, but the director is Lynn Walton, and Lynn was a liquidator, but she came over from the dark side and decided to help organisations recover what's theirs, recover what's due and owing, rather than be on the liquidator's side. You know, we often see a liquidator's first act in these sorts of situations to claim everything. So she helps people to recover their goods and have those registrations in place. So Access Intel is the entity. There's different use cases, and making sure that you've got the right PPSR area and where it applies is important. So whether or not it's sale of goods on terms, retention of title, that lease hire, consignment, installation, secured credit payment plans, and those sorts of things, they should be covered. But you've got to be covered by the right area.
So moving on from the PPSR and actually moving backwards to something that you mentioned a bit earlier, I want to talk a little bit about credit checks.
Yes.
So you obviously, you mentioned getting credit checks done on clients. It makes life a lot easier.
Yes.
For someone who is purely residential, can they do that? Or is there a way for them to do a credit check on their client?
Unless you're a finance extender, so a bank, a credit card company, a utility, a phone company, no, you can't. And you must have a credit license. So no, you can't do a credit check on consumers, only on registered entities, and that's ABN holders or ACN holders. If you're dealing with a consumer, it's the check measures that you put in place, but that is where I'd be getting a good deposit up front and, you know, your solid progress payments as you go through, or in the alternative, finding somebody that you can partner with that will take on the financial risk for you. So a funder, and then you don't have to bother with that. You just need to do a great install.
And if their client is B2B, how would they go about doing the credit check? Who would they need to talk to do that?
There's a number of different parties, and historically the parties didn't share information. They were quite siloed. So the credit report was as good as the number of members or subscribers the bureaus had to their databases. And you had different industries and sectors that followed different crowds. So some of the names that people might remember would be Dun & Bradstreet, which is now Ilion. You might remember Baycorp, or Vida, or Equifax. They've had a few iterations there as well. Access Intel is another organisation that does searches, but they're a little different in that they're an aggregator. They don't create a bureau. They take the information from 3 different bureaus and aggregate the data, which I think is really valuable. You're cracking into those silos and getting deeper data. What you're looking for is information that verifies who you're dealing with. So the corporate entity or the exact corporate entity, you might think that for example, you might think that you're dealing with Hutchies, but in fact, Hutchisons have a raft of different corporate entities. So you need to make sure which of those legal entities you're dealing with. And you do that by checking their ACN. And I know everybody defaults to an ABN, but an ABN, you've got to keep in mind, is for tax purposes. The ACN is the better way to identify. If you identify that there's a trust involved, you need to understand and make sure that you're dealing with the trustee for the trust, which can get a bit murky. It will identify things like the business structure. So whether or not it's a company, a sole trader, or a trust. It'll give you key addresses, so the registered office and the trading address. And the registered office becomes important if they fail to pay and you do need to serve some sort of legal process. It has to be served on the registered office. And it gives you a look at the directors and shareholders. So I mentioned earlier, checking out directors and shareholders in case you recognise the name, who might have had a failed entity before, and you can see whether or not you want to take the risk. Commercial credit scores from Equifax, Cilion, Creditor Watch, etc., or Access Intel give you a commercial credit score and a risk rating using their aggregated data. The risk would be something like, low, medium, or high, and it would predict the likelihood of a payment default or insolvency. And it provides an overall snapshot of how risky the customer is, especially when compared with their industry peers. So it doesn't just hold them out on their own and go, well, how are you comparing to the rest of the companies in Australia? It compares apples to apples, developer to developer, for example. Payment history, you look beyond the usual terms. So days beyond terms is one of the measures. An example of that is what we've been talking about, where a lot of accounts are being paid at 42 days plus at the moment. It looks at trade history with other suppliers. Craig touched on it earlier about ATO defaults. Now, that's a fairly new thing. The ATO never historically shared tax debt with credit bureaus, but I think it helps us make a far more informed decision now to understand if there's an ATO debt about what we should or shouldn't do. It also covers court judgments and overdue debts. In most instances, so the bureaus, the Equifax and Cilion and whatnot, cover court judgments and overdue debts. Access Intel have another level of data through Alaris, which is all court actions. But sometimes that can be irrelevant. It might be a fair work claim. It might be a car accident. So you've got to be able to identify what's relevant to the decision that you're making and what isn't. I think court actions and legal notices are really important. You'll see how many court judgments or unpaid debts. So in the legal process, you have to issue a claim first. For those of us that are my vintage, that's the new word for a summons. So issue the claim and statement of claim first, serve that document, wait 28 days or more, then obtain an application for judgment through the courts. The courts acknowledge that the debt is not disputed, is still outstanding, and that you can enforce it in some way, enforce the judgment debt. That could be through a writ, it could be through a winding up application, it could be through, in some cases, taking out or getting a security over the property, which Craig can talk more about. It also covers off any insolvencies or administrations, which are really important. But the director's history and cross-directorships, it prints off a little almost family tree as part of the search to show what other entities the director's involved in, because they might be doing a bit of game of, walnut shells to hide the debt. And it helps you scratch the surface and all of that. They're cheap, again, cheap as chips to do. If you're looking at spending between $20 on a basic asset search and going up to $50, $60 for a deep dive on their credit report, what is that in terms of the percentage of an average job size? It's peanuts.
And if, say, an integrator has started a job and they've completed a job and they now need to move into debt recovery because they haven't been paid, what does that process look like?
We tend to do a front-end piece. So we validate the entity that our clients have been dealing with. We risk score an account when it comes into our office to see realistically the likelihood of recovery. It could start off with the issue of a letter of demand and phone calls requesting payment, and sometimes that's enough, or at least enough to get them on a regular payment plan. It's really interesting because we've had clients who've huffed and puffed and huffed and puffed to try and get a bill paid and threatened and jumped up and down. And we might send a letter, a phone call, and we're able to cut through. I think it's kind of like, ask your mother, ask your father. When somebody steps in, they realise that you're serious and they have to pay the account and that it's going to cost them more if they don't. If they don't address the account and searches are indicating that they do have the ability to pay, but they're just not, then we might proceed with commencement of formal legal action. And I might hand over to Craig here.
Yeah, so as part of the recovery process, sort of at the beginning as well, that's when, provided the creditor is onto it quickly, we would be looking at security repayments to see if that's still alive in terms of what could be done. So if the timeframes are still available, then there could be things that might be done through that legislation. as I said before, there's strict timeframes with when things need to be done, and if it hasn't been done, then the legislation won't apply to that. But it doesn't mean you can't still take action. It just means you can't take action under that act. So it wouldn't allow you to do the adjudication process, or you can still proceed in court against someone if they've breached the act. But if the timeframe's expired, you can still just go to court for the unpaid debt as well. So it doesn't prevent you from doing it. But finally important, if you are using that act and you've got on your invoice the relevant reference, then you need to do that quickly and not in 3 months' time. But in terms of the legal process, once the debt recovery letter and demands and those sorts of things has happened, if the person's ignoring it or wanted a payment arrangement and then defaulted or whatever it might be, then that's when you would institute proceedings. As Angela said, it's a claim and statement of claim in Queensland. It's a statement of claim in New South Wales. It's a complaint in Victoria. But they're all the same thing in the sense that you're giving the court, the relevant court, the story. You entered an agreement on this day, did the work, invoiced, hasn't been paid, whatever the story is, and then the amount, obviously, of what the debt is. In most jurisdictions, the costs of all that are added onto the debt, provided whoever the lawyer is charging you on what's called the scale. Most of those costs will be recoverable, and you also claim interest depending on jurisdiction, but generally around 8.35% in most of the Queensland, Victoria, and New South Wales jurisdictions, and it can go up in others, but 8.35%, which is tied to the Reserve Bank plus 3.5% or something like that, I guess. And you tell the story to the court, you file it, and you then need to serve it on normally in the circumstances we're talking about, it'd be a company. So back to having a search, every company has a registered office, and that's where all official things go to and have to go to the registered office. So it'll be posted there, and then they've got the time frame, which could be 28 for Queensland, New South Wales, 21 for Victoria, and generally 28 in Western Australia and South Australia. And then they've got to basically either pay the debt, and that also includes the costs and the interest, or they get an opportunity if they want to tell an alternative story to the court, and that's through what's called a defence. So they dispute it, and they have to give the reason as to why. Generally, what happens if someone's ignored you, they may come up with a dispute when it comes to this, or they simply don't have the cash to pay, whatever it might be. But you can then get what's called default judgment, which sounds really wonderful, but essentially it's just a piece of paper that the court issues that says that the particular customer owes you XYZ in terms of dollars. But you then go through the process of enforcing that piece of paper. People that haven't gone through the process before, some think that once you've got that piece of paper that you'll get paid. Unfortunately, it's a piece of paper that's an order of the court, but they don't have the power to extract it from that person without going through other means that the creditor would have to institute. And that could be where you get a bailiff to go out to the property to claim items and then essentially auction those off to pay the debt, garnish your bank accounts, so they might have money in the bank and the court would order that part of that is taken out and transferred to you. An enforcement hearing where you could bring the director before the court to answer all questions about their finances. They have to bring bank statements, copies of BASs, those sorts of things, so you can check to see if they're essentially home accepting, and the court can order things to be paid from there. But the unfortunate thing with all this is, as I've said, it does take some time. It's not an overnight thing. If you are faced with having to do debt recovery, be prepared for it to take some time, but know that if you follow the steps, there will be a conclusion. It mightn't be that they don't have any money and the company gets wound up, but it's important to follow the steps and follow the course. It can take some time, however, you're probably looking at potentially 2 to 3 months before you get some responses. But as I said, important to follow the course once it goes to the legal process.
I know that we've mentioned our foundation documents, our application forms, our terms and conditions at many stages in the conversation, but these documents are the tools in our collections toolkit that I would be using in a debt collection process and Craig would be as part of an enforcement process. So we touched on at the beginning that securities are important, and within a contract, securities could cover a guarantee, a director's guarantee or a personal guarantee. It could cover a caviable interest over somebody's property or a lien in some way. It could cover the PPSR registrations and that type of thing. They're the protections that you have to get in place. Your insurance is for just in case. And we talked also about searches, that it's important to do searches on your customers before you start engaging with them. I mean, you can spend a lot of time pitching and tendering, but they may not be worthy. But if you do decide that they are worthy, it shouldn't stop there. You should continue to monitor. So when you do some searches, some corporate credit reports, you can set a 12-month monitor. So if anything changes with that entity along your relationship road, you've got the information quickly and you've got the information to be able to change your tack depending upon what you need to do to protect your interests the best.
So one of the things that you've both said during this call is around the idea of acting quickly. So how quick is quickly? And is it possible for an integrator to be too proactive in chasing outstanding debt?
I don't think that there's such a thing as being too proactive at making sure that you get paid for the work that you're doing or the goods that you're supplying. We actually encourage some of our clients to not so much do a collection call before the invoice is due, but certainly a customer care call before the invoice is due to make sure that the client is happy with the goods and the services and everything is working to plan. And you think, why would you do that? Aside from good customer service, what you're doing is taking away any opportunity of a dispute or rectifying a dispute or an issue early. We have clients that, I don't know, say you're on terms of 14 days, your invoice should be paid 14 days after supply. If you, at that 7-day mark, did the customer care call and made sure everything was in order, then you could do an assumptive close on that one and go, oh, fantastic, we're so happy, we'd love for you to recommend us to other people. In addition to that, can I just schedule that payment and note it in our register that you'll be paying that on Friday? That's not a hard collection because people say to me, I hate making these calls. That's not a hard collection call. That's a good customer care and customer service call. And you're balancing intention. If somebody says, oh, we'll try, then you can box it around that. You might want to give them a couple of days leeway. But if they're already outside your terms, there are different types of reminders that you could send. So I think from conversations with a lot of your integrators, Xero seems to be the accounting package du jour. So through Xero, you can set up some automated reminders, aka nag chains, in the background, and you can set your pace in terms of timing. So it might be, if your terms are 14 days, you're setting it in place at 7 days after that to send a reminder. Within your reminder, include the link so that you're easy to pay and maybe consider some alternative payment methods, credit card, that type of thing, rather than just EFT. And then you can increase or change your wording as the delinquency increases. It's a commercial business decision as to how far you let that roll. But realistically, the average days to pay at the moment are around 42. So if you're seeing an invoice that should have been paid sometime prior to your 42nd day, then it's a case of do something. We encourage our clients to use our name within our demand letters or within their final requests for payment. And the reason is it shows the other party that you do have a process in place. You're not just chucking it out there that I'm going to send this to the debt collector or the lawyer. You're going to send it to Optimum Recoveries or SMS Law. It shows you've got a process. And when they do hear from us, they're not surprised. They know why we're calling and they know the matter's escalating and it's going to start to cost them additional funds.
The other purpose of that call, Angela, as well, is most disputes come from the invoice is wrong, that I didn't get that, you didn't spend that much time, whatever it is.
Yep.
Or oh, that invoice has been made out to the wrong entity. It should be made out to Billy Bob's, whatever. So the purpose of that call as well is, did you get the invoice? Yes. Yes, we're paying it. Or if that's when they're going to say, oh, it's wrong because of this. And so you can deal with that within that time if it's relevant. If you don't do things like that, they don't pay it. You then, go through the process we were talking about in terms of debt recovery, and then they say, oh, but the invoice should have been this, or you didn't provide that particular piece of equipment or whatever it might be. So it's better to get all that sorted out, obviously, before to eliminate those sort of dispute points. Doesn't mean they won't bring it up again later, but better to do that at the beginning.
You've got a nice evidentiary trail that covers off any of those claims. With that evidentiary trail in mind, I do love a good photo. So if the guys have completed a job, it's been done nicely, they've cleaned up after themselves, it's nice to have a photograph. We have clients that work in that service space where, in addition to the photographs when they're sending it to the client, so they'll send the invoice through the system with a photograph of the completed job, ask for any feedback and include a review. So if you've given somebody a 5-star review, there's no dispute. You're setting up the long game.
So let's say, to wrap everything up in a nice little bow, what's the one thing that integrators can take away from this podcast, from this episode of this podcast, to better protect themselves moving forward? If they can just make one simple change, what's that first step they should do?
I think if they're listening and they're thinking, I probably need to get on top of this, they're not alone. And carving out time in a day is hard, but you've got to start with your foundations. So considering the client's journey, how they find you, how you communicate with them, making sure that your terms are consistent. So your quotation terms match your contract terms and match your statement terms, that everything's consistent. That needs to come into play. And Craig and I talked about making sure that those contracts have the right terms for the right style of customer in play. We're certainly happy to help. We've talked to you about complimentary reviews that we conduct for people and let them know whether or not their current terms and conditions are appropriate or whether or not they might just need a little tweak. It's not often that terms and conditions, unless somebody's, operating without any, the old handshake, it's not often that Craig and I will send something back that needs a complete rewrite. It's generally a bit of a tweak here and there to make sure that they're up to date with the legislations and the like. But good foundations and good procedures and processes. So, in short, that to me looks like a new contract, and it looks to me like a credit policy and procedure.
Angela stole my answer to that. But if you are faced with, just sort of touching on where the quickness and sort of the head in the sand situation and the mates, and you see a lot of, oh, look, I can't pay you for that, but look, I've got this other job coming up that I'll get you to do, and it sort of spirals from there. If any of the listeners are, faced with a growing list of debts, it's a good time to get on to those, and making those sorts of calls probably is not something that you want to do. And the reason that you shouldn't do it is you'll get bogged down potentially with the particular job that you did, and you didn't do this or whatever it is. So getting someone else involved within the business, or outsourcing, debt recovery, for instance, the quicker you do that, the quicker you're going to get paid, or make a decision that it's written off or whatever it is. But rather than it sitting there, the quicker you do it, the better off you will be. And if there's disputes in there, they can be sorted out. But I think if you're faced with a long list and you're getting promises, you've got to draw a line in the sand and take some action with either yourself or outsourcing to a debt recovery. I think would be the other sort of tie a bow on it, and hopefully you've got all your terms and conditions and all that stuff in the background. And if you don't have any, it doesn't mean that you shouldn't get paid either. It's just a little bit more difficult, but if you don't try, then you won't get anything. So that would be my way of tying
In
it
a
off.
basic form, a text message is a contract. It's just not ideal.
Yeah.
One thing I want to just flag is collecting an unpaid account is really emotional. Can be, because it could make or break some businesses, and there's a temptation to kind of go at it like a bull at a red rag. So the team should be aware that there are rules around the way in which you approach people about paying accounts, and they sit under the ACCC ASIC guidelines for creditors and collectors. That shapes the number of contacts that you can make, and a phone message is a contact. So a phone message, a text message, a site visit, an email, they're all contacts. They're considered contact. And it's also the way in which you communicate. So the tone of your voice, if you sounded aggressive or if you used language which might otherwise just be considered part of the Aussie vernacular, but someone took offense to, then you could be in trouble. But it's generally when you start to go above and beyond and contact somebody every day, for example. You can't do that. Your number of contacts are limited, and whoever's responsible in the business for making those phone calls should make themselves aware of the guidelines in pursuing an account for creditors and collectors. At the end of the day, we're protecting, or you'd be protecting your business. And it's not just about chasing money when things go wrong. It's about putting the right steps in place before they do. So whether it's tightening terms, registering on the PPSR, or just having the confidence to have tough payment conversations early, it all helps the business owner stay in control.
Thank you both for joining me. This has been really interesting. I think there's a lot of people who are going to be listening to this, and hopefully it will change a few minds and get them to actually take it a little bit more seriously, which would be good.
Oh, it's our pleasure. Thank you, Paul, for having us on.
That was Angela McDonald and Craig Mason. And I would hazard a guess that every integrator listening has a story that sounds a little too close to what they've just heard described. We've all been there. Work's been done, gears on site, maybe even installed, and then the excuses start. No paperwork, no payment, no recourse. But it doesn't have to be that way. As Angela said, do the paperwork before you do the work. Whether it's setting clear terms, checking your client's credit, or registering your interest on the PPSR, these are small, simple steps that protect your time, your money, and your sanity. If you'd like to get better at any of this, or just want to share your own horror story, reach out at info@masterintegrator.com.au or follow Master Integrator on LinkedIn. Thanks again to our sponsors, Integrate Unlimited, Coliseum, and Connected Magazine for making this episode possible. Thank you for listening to Master Integrator. I'm Paul Skelton. I'll see you next time.